put a timer up there for you.
15 minutes. Okay, great. All right. Well, welcome. How is that? Okay. All right. The first question I usually ask is how many people have seen the presentations that I have given? That also allows me to slow to go. Okay. Well, good. All right. What I'm going to do today is just give you a. I'm going to have to kind of brush over the signals. I've been trading. Oh, I started as a stockbroker back in 1975. Got out of the business because I discovered that the analysts on Wall Street didn't know any more than what we did. They just had more access to information back then. So afterwards, I discovered, or somebody put candlesticks on my desk. When I started learning them, they just made sense. I mean, just common sense. So since then, I've written 3 books on candlestick analysis. And so what I have discovered is that if you just learn those, you get 2 bonuses. Number 1, you'll recognize when reversals are occurring in a trend, and that also allows you to analyze when a trend is in continuation. And secondly, because the Japanese rice traders have developed these over the last 400 years, not only did they recognize or demonstrate when a reversal was occurring, they also saw what the psychology was in creating that reversal. So just understanding the candlesticks kind of puts you in the same frame as a well-seasoned trader. Commodities, Forex, straight currencies, stocks, and a lot of people say, well, does it work for options? Yes, it works for options very well because you're not trading options, you're trading the underlying stock or whatever you're trading as the underlying entity. So what I discovered was that prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals, and all we're looking at on candlestick analysis is the graphic depiction of what's going on in human emotions. So the most basic element of candlestick signals are the result of the cumulative knowledge of everybody buying and selling during a particular time frame. And that time frame could be a 1-minute, 3-minute, 10-minute combination, or if you're a long-term investor, a daily, weekly, monthly combination based on emotions. And when candlesticks came along, it just reversed me 180 degrees because I knew I was doing everything exactly wrong at the wrong time. And so we're going to go through real quick the basics. The basics of candlestick analysis is the Japanese rice trader said if something opens here and it closes above where it opens, it creates a white candle. If it opens here and closes here, it creates a dark candle. That doesn't necessarily mean the price of the stock is up or down on the day. All that basically means is what was going on in investor sentiment, clearly what is going on in the trades. There are 50 or 60 signals in candlestick analysis. We've narrowed it down to 12. If you understand these 12 major signals, you're pretty much going to understand or be able to recognize when there's reversals. Are you a maven? No, I'm not a maven. I'm just kind of a frump. I just try to learn what I know, and so yeah, a white candle, that doesn't necessarily mean it closed up or down on the day. If you have a big gap up and it closes lower, you're going to have a dark candle, but the price is still going to be up on the day. Now, what I discovered was a lot of people have candlestick signals on their charts. They just don't understand how to use them. And so me being terribly emotional, I wanted to learn what the basic common sense was in the candlestick signals. And so now I've discovered that a lot of people use the candlestick signals because graphically they're much more clear. But if you don't understand what they're telling you, they don't really do you a whole lot of good. And I kind of equate it to the young Indian that left the reservation, got accepted at Harvard, graduated top of his class, went on to Wall Street, was making millions of dollars when the tribe asked him to come back and be chief of the tribe. And his heritage was much stronger than his will to make money, so he went back to be chief. And the first day he got back to the reservation, all the elders came filing into his teepee and said, how much wood should we collect for the winter? And he had no earthly idea. He said, go out, come back in an hour, and I'll have the answer for you. So they all filed out. He flipped open his cell phone, called the local weather station, and said, hey, what's your indicators look like for the winter? The wood, just to be safe. They all did. A few days later, he called the weather station. Everything, called up and said, does everything look like it's all right still? And he goes, oh, it's going to be a little bit colder than it was last year. He goes, oh, man. So he called everybody in. He said, go out and collect another 2 weeks worth of wood. They all did. A few days later, just to be safe, he called the weather station again and said, what's your weather look like now? Everything's still all right? And he goes, oh, it's going to be a little bit colder than we expected. And he goes, man, oh, man. So he called everybody in, said, you better go collect another 2 weeks worth of wood. They did, and they were grumbling, probably like you all here sitting listening to this story. A few days later, he calls up and says, what's your weather look like now? And he said, oh, it's going to be a little bit colder than we expected. And he goes, man. So he called everybody in and did. They were grumbling by this time. And just to check, he called a few days later. He said, all right, what do your indicators look like now? And they said, oh, we're going to have one of the worst winters in the world that we've ever had. And he goes, what the heck is wrong with your computer indicators? You can't get anything right. And he goes, oh, we don't use computer indicators. We watch the Indians. The more wood they collect, the colder the winter's going to be. So if you don't know what your signal right now, using candlestick signals, it allows us to look for signals and patterns. And what are we looking for in those signals and patterns? We're looking for when it is time to buy and when it's time to sell. This one we did a while back, and we had a good 80% gain in it. Do we always get 80% gains? Definitely not. But the nice thing about candlestick analysis is it puts you in conditions. I show this graphic because a lot of investors with trading techniques say, yeah, we made a lot of money here, and we made a lot of money here. I'm not interested in what money they made. What I'm interested in, what happened here and what happened here that tell me that this move is going to occur. So that's the basis of candlestick analysis. So as we go through this, there's just some very simple indicators that we do as confirming indicators. On this chart, we have the 200-day moving average and the 50-day moving average. Those moving averages, we also usually have the 20-day moving average. I just didn't grab it on this chart. Those three moving averages we use because every money manager in the world uses the 20, the 50, and the 200 to make decisions. The benefit we have with candlestick analysis is we can see exactly at those moving averages what's going on in close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. On the short side, you stay short until you see a candlestick buy signal and a close back up above the T line. Let's see, more than what the others say they made. I'm more interested in what they preached. Okay. All right, here we go then. So what we're going to do today is we're going to try to figure out if we know the common sense aspects that built into candlestick signals. Candlestick signals and gaps, we've got a huge advantage of doing or trading based upon what the forces are after a candlestick reversal signal. Raju, the 20, the 50, and the 200 are all simple moving averages. The T line, the 8 exponential, obviously if it's an 8 exponential, it's an exponential moving average. So the 20, 50, and 200 are all simple. So now out of the 4 basic signals, 2 of them show force. And that is if you see a candlestick sell signal, buy signal in the oversold area and they gap it up, that's going to produce a very strong uptrend. If you see a candle, very strong downtrend. The other 2 show exhaustion. And that is if you see a candlestick reversal signal that has gapped up in the overbought condition, that's when you start looking for a sell signal immediately. If you see a gap down in the oversold condition and see a candlestick reversal signal, that's when you start watching for a buy signal. Now, that starts your uptrend. You see a gap up in the overbought condition, you start watching to take profits. So the first one is that gap up in the overbought condition. What usually, this is a nice thing about candlestick analysis. It's all common sense built into it. They're all what we call fractal. They all work on the same time frames equally well. So if we see an get up in the overbought condition. Now my overbought condition is I use stochastics. Stochastics of 12.33. If it's above 80, it's in the overbought condition. If it's below 20, it's in the oversold condition. So if you see a gap up in the overbought condition, start watching for sell signal. Now, one of the nice things about the T line, it's probably a derivative of John Bogle. But the nice thing about it is that as long as it stays above the T line, you stay long, but there's a caveat to that. The further away it moves from the T line, the higher the probability it's going to come back and test it. So if we see a candlestick potential reversal signal that gapped up in the overbought condition and has moved away from the T line, the probability is it's time to take profits and pull back. Now, profit in a trade, man, oh man, this is going to be the one that makes me a fortune. I'll buy new cars, buy a new house. And then it comes up here and starts selling off. And my biggest fear is, what if I take profits here and it just takes off without me? A new wife. Probability which way the trend's going to move. So if I start seeing profit taking up here, I take profits. Where can I buy back? If they pull back to the T line and start doing a buy signal, that tells me to get back in again. So that exhaustion at the top is just mere common sense. Where do most people buy? They buy exuberantly at the top. If I'm up here in the overbought condition, and I start seeing potential sell signals, one of the very simple rules of a doji, the doji is one of the most popular 12 major signals. If it opens lower the next day after a doji in the overbought condition, take profits. Very simple rule of a doji. The price is usually going to move in the direction of how they open it after a doji. If it's above this little 80 line, it's overbought. If it's below the 20, it's oversold. Now, we don't trade stochastics. All we're doing is we want to see if we see a buy signal, is it occurring in the oversold condition? Very logically, if you see a candlestick buy signal in the oversold condition, you're probably going to see an uptrend. If you see a candlestick sell signal in the overbought condition, you're probably going to start seeing a downtrend. Now, I say probably. Nothing's set in stone, but the probabilities of being correct with candlestick signals is so high that if they didn't work, we wouldn't be watching them. "400 years later. They work just as accurately as they did back in the 16th and 17th century. The Japanese rice traders that developed this system, they weren't rocket scientists. I guess they didn't have rockets back then. They just watched the way to do it. They were aliens." So anyways, you see a gap up in the overbought condition, start taking profits. This is the exhaustion up there. And anytime I see these gap ups and then a doji, if it opens lower the next day, I'm definitely taking profits. What's the worst case scenario? If I'm in an overbought condition and I'm seeing potential sell signals and it buy back in, as long as that didn't create the sell signal. But the probabilities will be extremely strong that that's starting the downtrend. And if you see it at potential resistance levels, if you were buying down here, notice the nice thing about candlestick analysis. It tells you where the buying starts. Then it uses the moving averages to tell you once they break through a resistance level, they'll come back and act as support. Here's what we call a left-right combination, a doji followed by a bullish engulfing signal. A very strong bullish signal, which tells us if they're is expecting it to go to their 200. If they gap it up and do a spinning top with stochastics in the overbought area, where's it time to take profits? Probably as soon as you start seeing any selling at this level. Worst case scenario is they take it down and bring it right back up, telling you that 200 is not acting as a resistance anymore. You can buy back in. But the probabilities are extremely strong. If they gap it up with a spinning top right at a major resistance level, it's time to get out. Is this the absolute top when they gap it up? Not necessarily, but you probably got most of the profit from that trade. I'm not trying to buy at the absolute bottom or sell at the absolute top. I'm trying to get the fat part in between and then move on to another high probability situation. Doji gap up, they open it lower the next day, close out the position immediately. Tells you there's been a failure. Doji gap up, stochastics in the overbought area, start looking to take profits. Straight currencies, commodities, bonds, tulip bulbs, anything that has fear and greed in it. This presentation will be archived, yes. So I should have said before, don't bother trying to take notes. We're going to go too fast. This is all being recorded, and you'll get copies of it. Start seeing doji gap ups. Start getting ready to take profits. When they gap this down, Now, notice the T-line. The T-line has acted as support all the way up. Very simple rule. As long as it doesn't close below the T-line, you stay long. Now you have a doji followed by a gap down below the T-line, stochastics in the overbought area. That's the time to start taking profits. Gap up in the overbought condition, what do we want to start looking for? Profit taking. Doji gap down the next day. This tells us this was the top. Now it's time to start going short. Again, this is not rocket science. This is just common sense put into graphic depictions. Here's the most strongest reversal signal. This is called Europe. It tells you there's been a change of investor sentiment. Doji, gap down. Start going short. Doji, gap down. That gap down is telling you after a day of indecision, they've told you what the decision was. They want to get out of this position as fast as possible. Let me see what I'm missing here. Is there a scan list gap? Yes. Very simple to Shazam. Very simple scanning techniques for finding these. Just very simple formulas. Again, a gap up tells us to start looking for a sell signal. Gap down, there's a kind of a. Many software platforms will find these patterns for you. Yes, I've written formulas for TCNet, for Metastock. I haven't written them directly for Thinkorswim, but they're using a lot of my formulas. NinjaTrader. Let's see. Do you go short right away? Can we get the scanning formulas? It's all over our website, RM. I'll tell you a little bit more about our website for those that aren't familiar with it here in a few minutes. Let me get through some of these. A gap down at the bottom. Where do most people sell? They panic sell at the bottom. The T-line is the 8 exponential moving average. So there's a very good probability that if you see a downtrend and they gap it down and start seeing buy signals, for the longer term investor, I've discovered that anywhere from 4 to 16 weeks, this price movement after a gap down will move back up to fill this gap. Now, in cases like moving back up to fill the gap, that's one long-term strategy. Where do most people sell? They panic sell at the bottom, and when you start seeing reversal signals, what do we want to see the next day? We want to see bullish confirmation. That tells you there's been a change of investor sentiment, and it's time to get into the position. So a lot of people say, well, how do we grab for that fallen knife? Candlestick analysis does that very well for you. Panic sell at the bottom. If you see a gap down in an oversold condition, start watching for a buy signal. Here's our bullish Harami the next day. Bullish Harami has a very simple message. It tells you that the selling has stopped. What do we want to see the next day? They gap it up. Not only has the selling stopped, but the buyers have come right back in on this one. Gap down and tells us we have an extremely high probability that we want to be in the in that trade. Gap down tells us that especially if you're short, this is where you start taking your profits, because that tells you where the bulls are starting to step in. Now notice again, this is a green candle, but it was down huge that day. So this wasn't a bullish day. It just told you that once they opened it, the bulls were coming in. That's very important information when you're analyzing a stock price and or the markets in general. Excuse me. Gap down in the oversold condition. Start watching for buy signals. Bullish Harami tells us the selling has stopped. Now we're gapped up. There's an island reversal. There's a left-right combo. Anytime you have a doji with a combination of another signal, a doji followed by a bullish engulfing signal, stochastics coming up, and they gap it up, island reversal, as many factors as we can put into our analysis, but there's been a change of investor sentiment, the higher the probability that change is going to work. Friend is seeing a candlestick reversal signal in the oversold condition, followed by a gap up the next day. Remember, what is that gap up tell you? It tells you the buying force is so strong after an indecisive trading day that they can't wait to get back into this position. And that's exactly the type of position we want to get into, is an oversold condition, an indecisive trading day, a doji followed by a gap up. A doji followed by a gap up, we call your best friend, because you'll make tons of money. Just if you do not do any other trade technique other than finding dojis followed by a gap up, a profit, but you're usually going to make a very strong profit. Do you buy at the break of the hammer high, or do you wait for positive close after the hammer? No. If you see a hammer and an opens positive the next day in the oversold area, you buy immediately. That tells you exactly what's happening as the bulls are stepping in. Somebody asked me a few days back, or a few weeks back, how many days does it take for your technique to confirm there's a reversal? Because theirs took 3 or 4 days, or had to move above a certain level or a certain percentage. Candlesticks, much simpler. You see a doji fall in the over, you're going to be in the right position at the right time. There's that doji gap up. Tells us it's time to be buying. Where is it time to sell? A gap up in the overbought condition and a doji. If they open it lower, that'd be the time to start taking profits. Excuse me. Or if you see a gap up coming through a hook pattern, one of the very strong patterns of how investor sentiment works. See a J-hook pattern breaking out right at a resistance level. That tells us we have an extremely high probability there's going to be much more upside. Yeah, we teach scalping, Jimmy. We do a session, and I'll tell you the session. And one of the sessions is day trading techniques using candlestick signals. My stochastics are 12-3-3, and there's nothing set in stone on 12-3-3. All you have to do is take a chart. I just went back and said, all right, what's my stochastic settings? That if this is the low on this chart, what corresponds with that? And that's all I did. You can use 12, 4, 2, 14, 3, 1, whatever works where they coincide with the reversal, and at the bottom, the reversal's at the top. Oops, let me see. Or if we see a breakout situation, there we have a bullish downtrending channel. But notice what we did on this signal here. We had doji, doji, bullish engulfing signal, a close above the T line. That makes it very simple. If it opens positive the next day, what's it doing? Number one, it's breaking out through this level. Number two is confirming the bullish engulfing signal. Number three, it's staying above the T line. Number four is bringing the stochastics back up. Everything tells us when it's time to buy. When is it time to sell? Oh, that's right. This was a Kramer recommendation up here. That's what gapped it up. That was the time to start taking profits. This is another nice thing about candlestick signals. No matter who you listen to or who you hear, anytime you hear somebody's opinion, you got to remember that is just one person's opinion. What we're more interested in is what is the market. This is what the candlestick signal tells us. This is the cumulative knowledge of everybody buying and selling during that particular time frame. Are there situations where candlestick patterns override divergence stochastics levels? Yes. Now try to get into that here in a little bit. Lou, we'll get to the site here in a minute. Well, let's see. All right, I can. My site is the Candlestick Forum. We have a chat room that is open every single day. We usually have 200, 250 people in there with all different levels of trading experience and all entities. Some are trading commodities, some are trading stocks, some are trading options, some are scalping, some are swing traders like myself. I put out 2 or 3 stock picks every day, so that it is a constant learning process. That's all part of our membership. You get 2 or 3 stock picks, not so that you have stock picks, but so you can see what the rationale was for having or either buying or selling those positions. We don't like to. He sees this drunk weaving down the street in his car. He blows his whistle, pulls him over. As he walks up to the car, he looks in the back seat, and there's a penguin sitting there. And he goes, "What the heck are you doing with a penguin in your back seat?" And the drunk said, "Oh, I found him out on the street, and I don't know what to do with him." And the cop said, "Well, take him to the zoo." The drunk said, "That's a good idea. I didn't think of that." Well, the next day, the cop's standing there on the corner. Here comes this drunk weaving down the street again. His whistle, pulls him over, walks up to the window, and sure enough, there's that penguin sitting in the back seat. And I said, "Why? I thought I told you to take the penguin to the zoo." Drunk said, "I did, and he liked it so much, today we're going to a baseball game." So if you don't tell people why they're doing something, yes, teach a man to fish versus just feeding him fish. Message right here told you something. Now, this is kind of an inverted hammer doji. Inverted hammer has an extremely high probability that if you see an inverted hammer in the oversold area and they open up positive, the investor psychology was that the bears got nervous the previous day when it was trading up and were lead when it closed near the bottom of the trading range. They open up positive again. The bears say, "Shoot, the bulls are back here again. Get me out of the way." They start covering their short positions, and the buying comes in. Now, somebody was saying, do you set trailing stops? Yes. Candlestick analysis, positive. It's going positive. Then where should it not trade at all? If it opens positive and you're buying, it shouldn't come back down through here because that tells you the bears are still in control. You get right back out of the trade. I, for the last 35 some odd years, have listened to hundreds and hundreds of money managers say, cut your losses short and let your profits run. The only problem is I've never heard one single one of them tell you how you cut your losses short and let your profits run. Candlestick analysis, it's very simple techniques to tell you when the bulls are in control and when the bears are back in control. So it tells you when to be buying, when to be selling. That selling could be the next day or 2 months from now. All right, let me zip along here. Let's see, I get sidetracked. Let's see, I don't know why that is in here. Let's get to something else. All right, so if I see that doji in the oversold condition, now what is our basic rule? Our basic rule is if we see a candlestick buy signal or close above the T line, we want to be buying. Well, the caveat is, the further away you move from the T line, the higher the probability it's going to come back up and test it. So if I've got a candlestick reversal signal and they open up positive, it's not above the T line, but where's your first target? probably back up to the T line. Then you can see what it does from there. Now I'm going to take a little bit of, add a little one. We also have a very high probability. Somebody was asking or mentioned that you have high probability day trade situations. If I see a big bullish candle, the next day they follow it with a doji. If this starts trading positive the next day, the doji sandwich in here. Yes, we do employ the candlesticks, and I'll flip back to that, Martin. That was one of the first charts when I brought up on the Dow. And so you've got just as much capability of analyzing an individual stock trade as you do as you do on an individual stock trade as you do on a on the markets. All right, bullish Harami gap up. Where's our next target? Probably where everybody else is watching, up here at the 200-day moving average. Dojis, here's your best friend. Dojis gap up from a doji. Very simple rule of a doji. They're usually going to move it in the direction of how they open it after a doji. That tells you, especially when you've got everything set up, you're in an oversold condition, followed by a bullish confirmation. It's time to be buying. The high by a gap up, that's your best friend. You're going to see much how this uptrend started. Kind of a little doji, gap up through this resistance level. Then we have what we call a 45-degree off of there. Notice what we have here. This is a Morningstar signal. Big down day, a day of indecision, bullish day, and notice what they did from the day of indecision. They gapped it back up. This is now a J-hook pattern. What is our expectation after this gap up? Strong upside. If this is strong upside and it breaks out through this level, what do we have? We've got a J-hook pattern. That tells us if this is wave 1, T-line. You're going to be in a downtrend until they can close it back up above the T-line. Very common high probability trade on the short side. Doji, then they gap it down. If you see a doji right on the right on the T-line, very simple. They're going to move it in the direction of how they open it after a doji. They gap it down the next day, you want to be going short. That's telling us they're rolling us over. This downtrend is still in progress. If you see a support level and you start seeing sell signals and they gap it down through that support level, there's going to be more downside. Very notice we have an uptrend. Here's our fry pan bottom. This is a slow rounding pattern that breaks out through this level. Tells us there's going to be a slingshot effect. Now, a kicker signal is that they are an uptrend. The next day, they open it at or below the previous day's open and go the opposite direction. That tells you can start shorting here, or start shorting here, or start shorting here. The probabilities of being in the downtrend is going to be very strong. Moving the price of that stock. Gaps, yeah, can be caused by overnight price action. That usually means there's some sort of news that's created a big change from the previous day. Let's see. So again, candlestick signals followed by gaps give you extra information. They started gapping this up through investor sentiment in the opposite direction. These signals work just as well on Forex as they do anything else. Now, these all have formulas. As a matter of fact, we are right now in the process of getting formulas written up for Metastock, where you can just go in and find the high probability, high power trades. That what it did right here on the support level. Did a bullish Harami. Telling us that the selling had stopped. Then they gap it up the next day through the T-line. That tells us we can be buying, because now what type of pattern are we going to have? We're going to have that J-hook pattern setting up. And how's it starting? It's starting with a gap up. This is wave 1. There's a high probability of wave 3. This information is good for buying the stock. It's good for buying options or doing an option spread. TradeStation, I haven't worked with it. Oh, TradeStation, I think we're going to do some work for in the at the end of the summer. Is Metastock doing the same for Forex? Oh, Lou, I'll let Jeff Givey answer that for you. The J-hook pattern is a strong price move, and it pulls back. Now, notice we have an evening star signal. An evening star signal, big up day, day of indecision. The third day sells off, closing more than halfway down this candle. But notice when it was time to take profits, what stopped it? The T-line. See, buying here. So now we have wave 1. Now a J-hook pattern pulls back. You can start seeing immediately candlestick indecisive trading and starting back up. This is the J-hook, which means wave 1 and wave 3 are going to be equivalent. Let's see. All right. Oh, I'm running out of time here. And we've only got 79 more. Nah, just a few more slides. Where does a breakout occur? This is what we call a slow curve right in here. Of a slow curve and a big fry pan bottom, more upside. They gap it up. That tells us we're going more upside until we see a sell signal that starts trading back below the T-line. Kicker signal. Kicker signal is your strongest signal. It opens here and closes here, dark candle. The next day, they open it at or above the previous day's open and go the opposite direction. That tells you that there's an extremely high probability that the investor sentiment has not only been changed, but changed with such a force, you're going to have a very strong uptrend after that. This is one of our recommendations. Why? Notice what we had down here, just a series of dojis. Remember, a doji tells you there's indecision between the bulls and the bears. Then they gap it up. Where'd they gap it up? Gapped it up through the, and they gapped it up again. If they're gapping it up out of an oversold condition, what's that basically telling you? They're anxious to get back into the stock, and we want to be in positions where they're anxious to get back into the stock. This is going to imply there's much more upside. What are all the reasons? Doji gap up above the T line, another gap up, breaking this downtrending channel, stochastics coming up. All still very simple. How long do you hold this? Until you see a sell signal and a close back below the T line. What does this gap up tell us? Big price move. This is where I used to be buying. I mean, because everything looked good. Everything looked good. Oh man, finally I'm brave enough. And back in the 70s, 80s, the only place you got your information for buying and selling was from your stockbroker. Your stockbroker isn't anybody else other than somebody that decided they wanted to sell stock instead of Xerox machines or used cars. You see a gap up in an overbought condition away from the T line, what's the first thing you start doing? You start looking for a candlestick sell signal. Here's your best friend. Anytime you see a doji gap up above the T line and breaking out through a downtrending channel, you stay long until you see a sell signal. One. Or a doji gap down. You stay short until you see a candlestick buy signal. So what we wanted to use candlestick signals for is to kind of anticipate when is our next price move going to occur. Again, the doji in the overbought condition, we're looking for bullish confirmation. If we see our bullish confirmation gapping up, we want to be buying immediately. There's going to be other techniques that will need a % move or 3 or 4 more days to confirm that they're buying. We had been buying UNXL recently, not recently, but there's our slow curve. A slow curve is just a very slow process for telling you the investor sentiment is building up. That's popping. This type of pattern right here is an excellent day trade situation. It's up here when we started seeing sell signals. This is what we call the cradle pattern, a big down day, 4, 5, 6 trading days where it's trading absolutely flat, indecisive, and then another candle. Here's the headboard, here's the bed, here's the footboard. This cradle's kind of hanging down between two trends. This trend is usually going to be a very strong uptrend. Fry pan bottom. This is what we call the classic. Here's your fry pan bottom. You couldn't trade this one way or the other, no how. But notice where it broke out. Right here at the beginning of the pattern, it did a gap up, continued the uptrend, pulled back. Now what are we expecting? If it opens positive from here, that tells us we got this J-hook type pattern, which is the classic. Fry pan bottom creates a very strong uptrend. What's a J-hook pattern need? A strong uptrend, then a pullback. Notice the pullback. Very indecisive trading. Bulls and bears are fighting in here. The bulls start winning again. They get enthusiastic. That starts your next wave. Oops, how much time is that? Getting close. All right. I think I can zip through this. Gap up. Rounding bottom. Option trades. We were buying, these are the January 75s at 240. This is what helps you with option trades. Is you know that you're not only in the right place at the right time, but you're looking for situations that have big price moves. Slow curve. What is our expected results? A pop-up. This, again, this is not rocket science. This is just investor sentiment working the same way. If you see a reversal signal and above the T line, that triggers your buy. Another pop-up. Now, what I don't want to have people think is I'm just cherry picking good charts. We find these charts every single day. I mean, there's 7,500 trading entities out there. You can find the patterns every single day for these slow curves, because they usually indicate there's going to be a pop coming pretty soon. This is ABFS. We're in this last few days. Notice how this one started. a doji right on the 200-day support level, followed by a little gap up. Then they gapped it up through this resistance level. What's that telling us? So we're going to have what we call 45-degree strong uptrend. Then we have what we call a little scoop pattern or a rounding bottom, buying right back in here, bullish engulfing signal, trading above the T line, and bang. Friday they popped it back up. What do we expect from here? Stochastic still coming up to this little consolidation. Here's one, OSTK, that we're getting ready for Monday. Notice how this one started. Doji gap up, very strong price move. Now what we have is what we call kind of a scoop pattern, very flat handle, a pullback, and notice what was happening right in here to get us back into this position. A morning star signal with a doji. As it's trading positive, what's it doing? It's staying above the T line. Now where are we? Got a kind of a doji right here at the resistance level. We have some very simple rules. Yes, doji sandwich. If this opens positive after a doji, simple rule, it's going to move in the direction how they open it after a doji. If they open it positive, what's that probably telling us? That we're going to have another day like this, a doji sandwich. If we have another day like this, what's that telling us? That this resistance level is not going to be there, that this doji or this scoop pattern breakout or slingshot, and there's going to be more upside. HGG, high probability results. Notice our left-right combination, and then a gap up. That just pretty much told us we wanted to be in that trend. Right now, what's it doing? It's doing our little cradle pattern. What did it do? A doji followed by a bullish are going, or what they're setting up. So gaps and candlesticks show extra force in investor sentiment. And back to the scenario that most people say, stay away from gaps. If you use gaps, candlesticks and gaps, you're going to make a fortune. Not only are you going to be in the right direction at the right time, but you're going to be upwards. Now, obviously, we've got a special that you can't refuse. And I think Pat has this set up that that you can buy our gap presentation. I think it's 50% off. But wait, there's more. I think you also get a 30-day free trial to our website. Again, the 30-day free trial to our website is if you're studying one of our packages, then instead of just being out on your own, we've got a chat room with, again, 250 people in it every day. Monday night, I do a training session for the members. We go through what markets, or what the markets are doing, what the commodities are doing. Here's the Dow. Dow has some very simple trading analysis. It closed right back here on the T line. I wish I could make this a little bit bigger. It has to open positive, or we failed at the T line or at the 50. And we're back. If we open negative on Monday, that's telling us we failed at the 50. We're back below the T line. That puts us into what we call a blue ice failure, where somebody fell through the ice. This was named by Not Seeing Graph. Uh-oh, what's happening here? Go. Let's see if that does anything. There we go. Sorry about that. All right, this is the Dow. So this is our analysis. It has to open positive and trade positive. What usually happens when it hits a resistance level? It backs off. Well, if it can't close below the T-line, that tells us we're going to be in a T-line crunch that will push us back up through. If it opens negative, it tells us the T-line's not holding. Now we've got a different pattern with, again, the blue ice failure. This being the support level in the past. If it falls down through the support level, it's like falling through the ice. Then what does the market do? It comes up to see if it can find the hole that it fell through. If it can't, as well on a 5-minute chart, a 1-minute chart, a 30-minute chart, as it does on a daily, weekly, or monthly. Any futures skill? I'm sure there are. You've got once you go into the room, you're going to find the people that are kind of trading the same things you are. And the nice thing about the chat room is you've got everybody looking for the same type of signals and patterns for different time frames. So you just find the ones that are finding the ones that you're looking for. Let's see, are 2 people speaking? If there any questions, again, there was the link up there. Let's see if I can do it again. The reason you want to start learning some of these, again, Metastock is going to have all the high profit patterns, and that's going to be available very soon. And again, this is not rocket science. Human investor or human investment or human sentiment doesn't change from day to day, week to week, month to month, year to year, century to century. All right. So, anyways, come join us in the chat room. I think we got a 30-day free trial with this setup. This is not rocket science. I tell people, as long as you can see, you can trade candlesticks. It's like the old couple getting ready for bed, and she's standing there naked in front of the mirror, and she said, look at me. My face is wrinkly, my arms are spindly, my breasts are sagging, my butt's skinny, my legs are scrawny. You turn around to her husband and says, is there anything you say about my body that would make me feel good? He goes, well, your eyesight's still pretty good. So as long as you can see, you don't have to be a high technician. All you have to do is know the signals, and that will tell you when it's time to buy or sell. Okay, how much time are we out of time, Morgan? Okay. All right. Thank you, everybody, for showing up. I hope you have a nice summer day. We'll hopefully see you all in the chat rooms.
All right, great. Thank you, Steve. Excellent job as usual. We always appreciate you being here. And like I said, Steve's trading is even better than his jokes. So hope that you guys enjoyed that. We did record the session. I'll post this link one more time. Here's the link to get the offer that Steve talked about. And I think that you guys will really enjoy it. You see a lot of people who have taken up Steve and are part of his room that have nice things to say as well. So Bob, we'll do the recording. I don't believe we'll have a copy of the slides for you, but again, we will have a copy of the recordings posted for you on everything. All right, our next speaker is a good friend of mine. It's Jeff Gibby of Metastock. And I tell you what, guys, why don't we do this? We'll take a quick, why don't we do about a 2 or 3 minute break. I'll put a timer up there to give you guys a minute real quick. So we'll put a 3-minute timer up there, give you guys a chance to take a look at Steve's offer, and then we'll go ahead and turn things over to Jeff.